You've probably been told that it makes sense to save your money as tax efficiently as possible. In the UK, the two main routes that individuals have to do that for themselves are ISAs and SIPPs. In this video, we'll show you how you can decide whether an ISA or a SIPP is the best home for your money. We'll run through the key differences between them, plus when they work for you and when they don't. Let's dive in. ISA and SIPP are both acronyms. They stand for Individual Savings Account and Self-Invested Personal Pension. Both of them offer tax benefits that, were you to save your money outside of an ISA or a SIPP, you would not get. In other words, you'll be left with more money at the end of the day saving inside them than you would have saving outside of these tax-efficient accounts. Now, when deciding between them, the very first question you need to ask yourself is, when will I need access to this money? That's because SIPPs are pensions, the clue's in the name, and pensions are primarily designed as a vehicle for you to save for your retirement. And because of that, they have rules to deter you from getting your money before a certain age. They're designed to incentivize you to save for retirement after all. SIPPs are what's called defined contribution pensions. That's jargon, but it just means a pension where you contribute and your money is usually invested until you need it. How much you have at the end depends on what you pay in and how much that money grows. These pensions, including SIPPs, won't let you access your money before the age of 55, rising to 57 in 2028. If you did withdraw your money before then, there would be very hefty tax penalties and it really wouldn't be worth it. ISAs, on the other hand, let you access your money whenever you want. There's one small exception to this, which is lifetime ISAs, but that's a separate issue and not really our focus here. So if this is money you want access to before the age of 55, then it's an ISA you want. But what if that choice is less clear? Maybe you know you won't touch this money for many years and you just want the most tax advantageous place to keep your money. Or you're close enough to 55 or to 57 that you're happy to wait. In those cases, you'll need to know more about how ISAs and SIPPs work. One key difference is the amounts that you can pay into each of them. For ISAs, you can usually pay in £20,000 in each financial year. This is your ISA allowance. You can hold your money in investments, in cash, or in a combination of these. For SIPPs, things are a bit more complicated. First of all, the money you can pay in each financial year, whilst also getting the tax benefits that come from pensions, is usually limited to the amount that you earn. Beyond that, there's a limit of £60,000. That's the annual allowance. So if you earn £50,000 a year, £50,000 is the most you can normally pay into a pension. If you earn £70,000, however, the most you could pay in would only be £60,000 because you're limited by that annual allowance. There is a way to make higher payments into a pension in some years by using unused allowance from preceding years. That's a process called carry forward, but you can only do that if you have that unused allowance to use up. For lots of people, the choice of ISA or SIPP will come down to one thing: the tax benefits. Again, it's ISAs which are a bit more simple. You pay into an ISA with money that has already been taxed. Then that money has the chance to grow with interest or investment returns without tax on those gains. Finally, you can withdraw ISA money or use it in a way that generates an income without any tax to pay. That can make an ISA extremely useful as a means of producing income later in your life, because you can take ISA income without tax to pay and thereby limit your taxable income from other sources. That can help to keep down your tax bill overall. For SIPPs, the rules are more detailed and the tax benefits you get depend on your personal circumstances, particularly the tax rate you pay when you contribute and withdraw your money. First, the easy bit. The returns you make on money held in a SIPP are tax-free, just like an ISA, but contributions and withdrawals are treated differently. Contributions into a SIPP benefit from tax relief, whilst withdrawals from a SIPP are taxed. In practice, this means that the amount you pay into a SIPP is automatically increased by the government. Tax relief at the basic rate of income tax is automatic, which means a contribution of 80p turns into £1 inside the SIPP. If you happen to be a higher or additional rate taxpayer, an extra amount of tax relief is also available. For higher rate taxpayers, a further 20p of tax relief is available, and for additional ratepayers, it's a further 25p. These extra amounts don't get added to your SIPP automatically. To get them, you may need to contact HMRC or else include details about them in a self-assessment tax return. Then you might get the money paid to you or otherwise get the benefit by paying less income tax in future years. But remember, this is the tax relief on contributions. You then pay income tax on the money you withdraw from a SIPP. But that doesn't have to mean that the benefit of tax relief is cancelled out. If you contribute to a SIPP and claim tax relief at a higher rate than the tax you pay on withdrawals, you'll be grabbing a big tax advantage. For example, a higher rate taxpayer who goes on to be a basic rate taxpayer in retirement. But the tax perks of SIPPs don't end there. 25% of everything you hold in a pension is available to withdraw tax-free. Bear in mind that this tax-free cash, known officially as the pension commencement lump sum, is limited. Currently, that limit is £268,275. That means you need your pension to be worth north of 1 million to be affected by the limit. Take all of these features together, and your SIPP has the potential to be a highly tax-efficient way to save. In fact, for anyone choosing between an ISA and a SIPP and looking simply for the biggest boost from the most tax breaks, a SIPP is likely to be the winner. But in truth, it's unnecessary to choose just one of these options. You can have both, and it will give you much more flexibility to plan your retirement income if you do. That's it for now. Remember to subscribe if you found this interesting to get more content from us, and thanks for watching.